Hi everyone, Eric with the Loan Lab. Today we're going to talk a bit about the Federal Reserve and mortgage rates. Okay, let's set the record straight. Every time the Federal Reserve lowers interest rates, people instantly think, yes, mortgage rates are dropping too. Time to go shopping. Not so fast. See, mortgage rates don't actually follow the Fed's short-term rate. They're tied much more closely to the 5 and 10-year Treasury yields that trade on the open markets. Here's why. When you lock in a 30-year mortgage, the bank isn't planning to sit around waiting 3 decades for your monthly checks. No, they package that mortgage and sell it to investors. And guess what investors compare it to? Government bonds. So if the Treasury yields go up, mortgages go up. If they go down, mortgages follow. The Fed, more of a side character, let me give a little callback to history. If you go back to just September, I believe, of last year, everybody swore mortgage rates were going to tank when the Fed cut interest rates. And they did 50 basis points of cuts over two months. Well, if you remember, as a spoiler alert, they didn't. In fact, they actually went higher. And it left people feeling like they'd ordered a steak dinner and got a lukewarm salad instead, right? So they were highly disappointed. Now, of course, politicians love pretending that the Fed is a magical thing. Pull a lever in Washington, and suddenly everybody gets a cheaper mortgage, cheaper gas, cheaper credit cards, hell, maybe even cheaper guacamole. Reality is a little bit different. The Fed cutting rates is more like your uncle promising he's finally going to go on a diet. Sounds great until you notice he's still buying Doritos. Mortgage rates, they wait to see what the bond market's doing, not what your uncle said at dinner. Now, back in the so-called good old days, you didn't need a chart, a tweet, or a CNBC push alert. You put on your good shoes, you went down to the bank, and you begged Mr. Jenkins for a loan. And if he said 19%, that was it. You smiled. You signed the papers, and you braced yourself for decades of canned beans and duct-taped lawn chair furniture. Trust me, today's rates aren't that scary. So, here's the bottom line. The Fed moves the short-term rates, okay? Mortgage rates move with Treasury yields. The two are related, but one doesn't guarantee the other. It's kind of like karaoke night. The Fed picks the song, but it's the bond market that actually sings. Sometimes it's off key. So, next time you hear Fed cuts rates, don't run to Zillow assuming your mortgage payment just dropped. Take a breath and remember the bond market. And hey, at least we don't need a mule, a pickaxe, and a 19% mortgage like in the good old days. If you like what we're presenting to you, please click on the subscribe and like button, and we look forward to seeing you at our next one. And in the end, just remember one thing, folks. It's all about perspective. So remember, perspective.